Joining me for this video in conjunction with REITweek 2020 is Danny Ismail, the senior analyst for the office sector with Green Street Advisors. Danny, thanks so much for joining us.
Thank you for having me.
Danny, I'd like to start by talking about the office sector post-pandemic and what your expectations are for the sector. Do you think most office workers will be working from home still?
It's really the million-dollar question facing the office sector these days, and I think we're still really in the early innings of determining what the permanent shifts that will occur as a result of the COVID-19 pandemic. However, what we are seeing is a real embrace of remote working by a variety of different companies across a variety of different industries, such as tech, finance, and consumer goods. Just in the last few weeks, we've seen statements by major companies such as Morgan Stanley, Barclays, and Twitter that signify that their need for physical office space will be significantly reduced in the future. Employers are finding that employee productivity is just the same, if not better, working from home as they are in the office. And employees are finding that working from home has its advantages, such as not having to take the morning commutes, avoiding public transit, and increased flexibility in their schedule. So how bad will that reduction in office demand be? Well, we think there's really two factors that will determine the shape of office demand in the future. The first is densification, and the second is remote working. So densification took place last cycle, and was the trend of employers really squeezing as many employees into the same amount of office space as they can, and really reducing their overall office footprint while growing their overall employee base. Now, employers may have gone a little bit too far in that densification trend, particularly in a socially distant world. So we think that's likely to reverse in the future and actually be a benefit to office demand. But as I just mentioned, remote working is likely to continue picking up steam as more and more companies adopt remote working practices, and that'll likely have a pretty significant impact to overall office demand. Densification last decade probably shaved around 3 to 4 percentage points off national occupancy. So a pretty big impact to overall office fundamentals, but the impact was felt over years, not months. Remote working could have a comparable impact to office demand in the future, but again, it will likely take a longer term frame to play out. There are some counter arguments to keep in mind. If you think about the factors that go into the success of an organization, such as culture and employee retention, all those will have to be tackled in a work from home scenario. And all those factors are incredibly important to the success of an organization. So our thoughts are that overall office demand will likely be reduced in the future, but there are some counter balances that will prevent everyone from working from home, most likely.
What is currently happening to office fundamentals and values?
We think office values are down about 10% across the nation. Now, the usual indicators of office sector health have been largely disrupted given various quarantine measures across the country. So your usual indications of office health stem from leasing activity, transactional activity, and all those have largely grinded to a halt, though you're starting to see a little bit of signs of life in recent weeks. However, based on our conversations with local market participants, your boots on the ground, as well as the information we can glean from publicly traded REITs and the public pricing of debt, we think office values are down about 10% nationally. If you look at the publicly traded office REITs, they're down significantly from the beginning of the year, in some cases down as much as 50%. However, when you strip away the effects of leverage, so remove the effects of a company's balance sheets decision, unlevered office values in the public market are down about 20%. Similarly, while debt spreads have widened, particularly at the beginning of the crisis, they've compressed a little bit given the actions by the Fed. So we'll know more as we start to see more leasing activity and transactional activity once the world returns to some version of normalcy post-COVID-19. But we think 10% down is a good betting line at the moment.
And finally, Danny, are there any markets that stand out as likely to perform better post-COVID-19 than other markets, as well as others that seem like they may underperform?
I think there's likely to be a broader geographic trend among office fundamentals over the next few years. And we would favor the non-gateway markets versus the gateway markets in that respect. The gateway markets are all those markets on the coast like New York and San Francisco, and non-gateway markets are everything in between. So Austin, Nashville, Atlanta, and so on. We think there are a variety of factors, both that existed pre-COVID-19 and others that will be enhanced post-COVID-19 that will play into that thesis. The first is, in terms of economic sensitivity, your non-gateway markets are generally less economically sensitive than their gateway market peers. So if you think about San Francisco, which is incredibly boom and bust, your non-gateway markets really don't exhibit that same level of volatility. So we don't know how bad the looming recession will ultimately end up being, but it's a fair bet that the non-gateway markets will exhibit less volatility than gateway markets. And the second is, there are broader secular trends that will likely be impacting all office markets across the country that will likely impact the gateway markets a bit more. So we just described remote working. That's a pretty big impact to office fundamentals. And we think that will likely impact your gateway markets more. But there are also other impacts that will hit gateway markets as well, such as the cost of living in many of these cities is already pretty high. Corporate relocations that have already been occurring from gateway markets to non-gateway markets will likely be enhanced. And the poor fiscal health of many of these gateway cities just gets even more dire given the effects of COVID-19. So there are a variety of trends, secular trends that we're facing in the gateway markets that we think will continue to happen post-COVID-19, which all play to, on a relative basis, favoring the non-gateway markets.
Great. Thank you so much for joining us, Danny.
Great. Thank you for having me.
For more on this and other REIT news and analysis, be sure to visit REIT.com.